Hi everyone, this is your host Latifa Swailah. Welcome to Qudwa's podcast powered by the CFA Society Bahrain. At Qudwa, we believe in the philosophy of paying it forward. This is why we are recreating our conversations that we have with people we look up to. We would like to take this time to thank Ahli United Bank in continuously supporting us in our initiatives. Today, we are joined with Hasan Haider, who has over 10 years of experience investing in MENA startups. Hassan is the founder and managing partner of Plus VC, an early-stage venture capital firm focused on the MENA region. Hassan was previously the managing partner of MENA at 500 startups and led the firm's growth in the MENA region over the last 5 years, turning 500 startups into the most active VC fund in the MENA region, raising and deploying the 500 Falcons fund, building partnerships and running programs in the region to help build the regional ecosystem. Hassan has invested in more than 180 startups in the region over the course of the last 10 years. Prior to 500, Hassan was the co-founder and CEO of Tenmou, the first business angels organization in Bahrain and one of the first in the MENA region. Hassan's work in developing angel investments in emerging markets through Tenmou has been picked up as a case study by the World Bank and was taught to Entrepreneurship Policy makers in Babson College. Welcome, Hassan.
You can go now.
Okay. Hassan, for someone who hasn't heard about the world of venture capital, how would you describe the business model of Plus VC and what's it like to work in venture capitals?
At the most basic level, venture capital really is investing in a company and acquiring some shares in it and hoping that those shares are valued at multiples of your investment, and then you actually end up by exiting and selling those shares. So that's what it is. I invest, I get some shares, hopefully the company does well and grows, and then I sell those shares to whoever will buy them at a later date. So that's what VC is at its core as an asset class. But it's a little bit different than private equity, which is something that's similar. It's a lot earlier in sort of the stage that we're going for. So we're looking at startups that are just getting started. They've maybe been in existence for 3 to 6 months. They've just started to acquire some customers and users. There's no clear path to profitability yet. There's a lot of unknowns. But again, like why we're investing in these companies is for growth. Like we're looking to get a 20 times return on our investment or something, whereas a private equity deal is a lot more mature. There's cash flows. There's a lot more to look at, but maybe they're looking at a 2 or 3x return on their exit. So that's really what VC is, I guess.
How would you describe Plus VC in that sense?
So Plus VC, we're an early stage venture capital firm that's focused on the Middle East and North Africa and MENA diaspora. So if there's founders from the MENA region anywhere else in the world, we'll be able to invest in them. Early stage, I guess, is seed and Series A is really where we play. The seed stage really is our focus for initial investment. Our definition of seed is the company has some customers, some users, usually maybe about $5,000 in monthly revenues, and the team sort of knows what they're doing in order to grow and expand and build on what it is they've done already. So we don't really invest in ideas, we don't invest in products, we wait until there's users that are using those products.
I've always been confused previously by what Series A, Series B,
sure.
seed stages. So could you please explain that to us?
Yeah, I mean, it's just a naming convention just to keep it easy in our mind where something is in terms of the stage of development of that company, the amount of funding they've received, the relative valuation that they're at. So at a broad sense, in the region, and the thing is, these definitions change by VC fund. These definitions change by region, by sort of industry, by whatever. So they're not like fixed definitions. But for us, what it is sort of pre-seed deals would probably be companies which are either at idea stage or have just launched a product, but probably don't have any users or customers or revenues. Seed for us is when they have some customers, some usage, but it's not significant yet. It's just sort of getting started. In the region, those deals are happening at valuations around between $1 to $5 million. On average, it's about a $3 million valuation, and the startups are raising anywhere between $500,000 to $1 million at that round. The seed round, sort of in VC, each round gets you to the next level of milestones, and your next milestones is how do we raise a Series A. Typically, startups that get to probably $100,000 in monthly revenues, they're on track to raise a Series A round. They'll typically in the region be raising anywhere between $2 to $5 million at valuations between $10 to $15 million, and then from there you get to Series B, where startups are probably generating $4 to $5 million in annualized revenues. And their valuation can go anywhere between 30 to 80, maybe even $100 million, and they're raising anywhere between 10 to $20 million at that sort of stage. So it's just a progression of where the company is in its lifestyle, and that's sort of what Series A, B, C. It's just a way for us to keep it easy in our minds, and to very clearly define what part of the company journey that we're sort of involved in.
All right, interesting. So from what I can recall about VC or plus VC in your instance, is that when you invest, there's a lot of uncertainty and unknown going on in there. So how do you pick what's a good investment from a bad one?
I wish I knew. I think in venture capital, it's very difficult to decide at an early stage what's definitely going to be successful and what's not. At Series A and B, it gets a little bit easier, but at seed, there's just so little data for you to run on. So, look, honestly, what I've seen, so I've done 180 investments. We've looked at probably 10,000 deals in the last 3 years. The factor that shows that something's going to succeed or not isn't the industry. It's not sort of the stage. It's not sort of the idea. It's none of that. It's purely the quality of the team that are working on this business. And so that's really what we're trying to figure out is how do we know whether this team is capable of building a startup and scaling it and growing it or not. And that's where the difficulty comes into venture capital, because how do you quantify a team? It's not a data, a number, or something like that. You can go in and be like, oh yeah, that looks like a good team. There's a lot of interpersonal skills and things that are involved. There's a lot of experience that's involved, and so it's much harder than a more traditional industry where it's, maybe asset management or something, where you look at the stock, you look at the performance of the company, and you decide whether it's undervalued or overvalued. Here it's is this a good team or not? And you're like, what are the numbers there? There's just no numbers to really look at. But it's the common denominator of the companies that are successful versus the companies that fail. It's not the industry. It's not the amount of funding. It's nothing else.
It's the potential of the team in itself.
And it's super weird to say that, but that sort of is what we're investing in. We're investing in teams, and we're investing in founders, and we're investing in sort of the potential that they show us, that they could grow a business and scale it and make it into $100 million, $200 million, $1 billion business. So that's really what it is. But VC is a very risky asset class. Like that's by definition. And you can look at the data and you can see that most of the investments are going to fail. And so you have to be aware that most of your decisions are going to be wrong, but some of them are going to end up right, and that's going to make the whole portfolio sort of come out well. And so that's sort of one of the things that we do in Plus VC. Like I don't think of myself as an amazing stock picker. I don't think there's any amazing stock pickers in the venture capital industry. There's just so little data that you can't really just say, oh yeah, I know exactly what's going to be a success, like at the early stage. It's not possible. And so the way that we invest is we look at how do we mitigate the level of risk that we have, that we're investing at this early stage in these teams and founders, whereas there's a lot of risks and unknowns that are going to appear over the next few years, and we can't really do due diligence on those. We can't really figure out what works or not at that early stage. There's so many things that can go wrong. And so our whole thesis shifted to how do we look at portfolio construction to minimize and mitigate that risk. And so our thesis is we're going to invest in 100 to 120 startups in a fund over a 3-year period. That sort of is built on the probability distribution of success in the sort of the early stage venture capital industry. The data, the numbers are 60% of investments are going to go to zero. 20% of investments will maybe give you 1x sort of your investment bank, which is, what's the point? Like, why would you invest and expect to get your money back? So about 80% of investments aren't worth anything. And so it's the top 20% of your investments that are really going to generate all the returns for your portfolio. But within that top 20%, there's a breakdown as well. So there's probably 10 to 13% of those will generate a 5 times return on your investment or more, like a 5x return. And only maybe a 5 to 7% of the portfolio will generate a 20 times return or more, so a 20x return. And what you're investing in venture capital is to get these outlier returns. So 20 times is great, but you want to try and get at least one company which generates you a 40 or 50 times return or more. And that probability is only 1 or 2% of the time within a broader portfolio. So if your probability of success to get those outliers is only 1 or 2%, you need to build a portfolio that's at least 100 companies in order for you to be able to hit that consistently across funds, across time periods, and do all of that. So that's how we've mitigated the risk. So we're able to quite confidently sort of say that we'll never have a 0x fund. We'll probably, the lower bound is about 2x that we'll be able to return to our investors, and the upper bound is about 6x, and the average is about 4x, using these sort of Monte Carlo simulations and the data that we have available to us. So like, I don't have data on the teams. I don't have data on what it is that I'm investing in so much, because it's a very fluffy sort of thing. Is this a good team or not? But I have data on the overall market's probability of success. And so based on that, that's what we build our investment thesis on. So one side balancing the other, I guess.
I get you. Yeah. So from what I understand is, to be working at a VC or to be a fund manager takes a lot of assertiveness in your decisions, because if you're quite unsure about whether to invest or not, or in your decisions already, I think that would take a huge hit on your future decisions as well, and what you're doing right now, right?
Yeah, I think you have to have a certain level of confidence, and you've got to just make a decision. Yeah, should I support this founder or not? Should I make this investment or not? And you have to be able to say yes or no. And actually, in VC, you have to have a bias towards saying yes rather than a bias towards saying no. Because like, for every single deal, there's probably 2 or 3 reasons to say yes, and probably 30 or 40 reasons to say no. And so if you're always just looking at, okay, what is the reason to say no? You'll always find a reason to say no in VC. But you always have to be looking for, what is the reason to say yes? How do I have a positive inclination towards the deals that I'm looking at, rather than looking and nitpicking and all the sort of negative things that could happen? Those fund managers tend not to last, because they just end up not doing any deals, and then the deals that they do that tick all their boxes and are perfect are usually not that great deals. There's always a level of risk. There's always a level of uncertainty when you're going into a deal that's really going to be an outlier. It's something different. It's it's either you're investing in something that people don't see the value of yet, but they will eventually, and those sort of, you're farming for sort of non-consensus deals, because those will perform much better than the ones that everyone agrees on is a great deal. The ones that everyone agrees on is a great deal, there's probably going to be a lot of people that will want to fund it. The valuation will go up, and maybe it won't end up being a great deal, because the probability of that being a great deal still isn't that high. It's those non-obvious sort of outliers, the contrarian sort of investments that you do, where you like, I see something here that other people don't. That's what you sort of have to do in VC, and that's the confidence that you sort of have to be able to get. And if I was investing in a small portfolio of 20 deals, I would not have that confidence. But with the way that we structured our investment, if one deal succeeds or fails, it doesn't really. If one deal fails, it doesn't make that much of a difference or impact on our portfolio. So we're able to take these sort of leaps of faith and invest in companies that are not obvious to others in the market, and those have done really well for us. Like we've invested in deals where no one else in the market was investing at like $1 million valuation, and then by the time the founders proved to the market that actually this is amazing what they're doing, now everyone's trying to jump in on that deal at a $22 million valuation. So like you've got to be able to take that sort of level of risk, and you've got to find ways to be able to do it. And it's not confidence for confidence sake. So you've got to figure out, am I within this portfolio construction that I do able to take this level of risk? And most VCs can't, because they just have too few investments in their portfolio, and that limits their ability to take that sort of outlier risk.
True, I get you. I've had a previous misconception that it takes a lot of experience for someone to make their own fund, to build their own fund. And previously I've been following this person, but I forgot his name, I can't think of him. But he started his own VC at the age of 23. So it got me wondering, what does it take to create your own fund?
Yeah, I mean, there's two factors into setting up your own firm and fund, right? One of them is, can you find the deal flow? And the other one is, can you raise the money? And those two things coming together results in a fund. So most people that are still getting started in the ecosystem or just getting their feet wet wouldn't have access to deals right off the bat. So someone might be able to raise the funds, but maybe would not get access to the deals that they might want to. And then there's people that have access to all the deals, and then fundraising is hard for them. So it's figuring those two things together is what enables you to raise a fund. And it's not about experience in VC per se. Like there's a lot of good fund managers that have been started. They initially were in a startup. They either succeeded or failed, but they have that sort of operating experience, and then they move on to VC and they start other startups and helping them grow and scale from their advice, from their network, from all that sort of stuff. Venture capital is a very network-driven sort of industry where you need to network in order to get access to deals. You need to network to get co-investors. You need to network to get funding. Like all these sort of things, it's just you're always talking to people. You're always looking for deals. You're always looking for investors and stuff. That's sort of the industry that it's like. So, yeah, sure. 23-year-old could, if he's built a startup and sort of sold it by 23, why not? If he has access to network, that also works as well. Or if he just has a lot of money, then that would also work as well. So it's just a factor of those two things. Like, can you find the good deals to invest in, and can you raise the money to invest in them?
So you need the network, you need the skills to fund your own VC, and also the skills to sell the shares.
Yeah. I mean, it's a lot of skills. It's just all into one, I guess. It's okay. One is, can you build the network which will allow you to get access to deals? One is, can you get access to all the deals that you would want to see in the market? And usually that's a little difficult. It takes years of building that sort of network to get access to all the deals that you want to have access to, right? Two is, can you build relationships within the ecosystem where if there's other VCs you want to invite into your deal, you can bring them in. You can help the startup fundraise at that stage and at later stages. And then the other skill set is on setting up a fund, right? So it's not been cheap. Like setting up Plus VC has cost money, and it's not free to set up a fund. You've got to take into account a lot of legal costs, a lot of regulatory and compliance costs, and all that sort of stuff. So you need a little bit of money just to get started and off the ground, just from an operating perspective. But it's not a lot. It's not as much as like a big investment bank or something would need just to get started. It's VCs are typically very lean operations, just a few people, not huge sort of amounts of people, and it's doable. So, and then the part that becomes difficult for some, easy for others, is sort of the fundraising, because VCs are essentially middlemen, right? We're we're not always investing. We're generally not investing our own money. We're investing someone else's money. So we set up a fund, we raise money into that fund, and then we deploy that fund into startups and investments that we want to do. And so if you're able to raise that fund, then that's a big part of the whole VC journey is fundraising from LPs for the fund.
Interesting. And what role does the VC play in this economy right now?
I honestly think that venture capital is one of the key drivers for economic development in the whole of the MENA region, I think, especially in the Gulf markets and in some of the Levant markets. I think historically what you've seen is when fresh graduates come out of university, they either get employed by the government or they get employed by large companies or financial institutions or something, which are already quite well established. The problem with that is the governments don't have that much funding anymore in order to hire everyone that graduates. And two, most of the large institutions are sort of done. Like, they don't really need to hire that many more people. It's pretty much they've reached their sort of limits in terms of hiring capability. And so how do you solve that? It's by building new businesses, right? And so venture capital is a key driver in building these new businesses, generating jobs and economic opportunity for all. Like, that's really a big part of it, right? So, I mean, we're not really impact investors, but everything we do has an impact angle in the region, because really we need to build a generation of founders that are building new businesses. We need a new generation of startups that are be able to grow, scale, hire more people. We need places for young graduates to go and work and build something and build their careers and just be able to survive, right? And so where is that what's the driver of all of that? It needs someone to fund these things and get them started and give them a chance to get started. And so that's what venture capital is, really, in its essence. It's a group of 3-4 people that came up with an idea, built a product, have a couple of customers, and have the potential to grow to be hundreds of millions of dollars and thousands of people employed. And that's what we're doing. We're investing in them and helping them get to what they need to go, where they need to go to. So I think, I've been saying this for years. It's been probably 10 years that I've been telling governments that you guys need to focus on venture capital and technology investments for a while. And over the last 2-3 years, we've seen that. So in Bahrain, there's the Al-Waha Fund that's been established, and that's been successful in getting a bunch of VC funds to establish in Bahrain, hire some Bahrainis and get that industry off the ground. You have Saudi SVC has been funding a bunch of Saudi VCs to get started and launched because they realize the value of sort of building that ecosystem. In Abu Dhabi, there's been a lot of efforts with ADIO and ADQ and a few others. And so the governments have started to wake up to see that, yes, they need to pay more attention to this, because it's not that much, right? Like, one building, one project in one of these countries in the GCC is a couple of $1 billion. The entire funding that took place in the entire MENA region for venture capital startups in the last year, in 2020, was less than $1 billion. So, like, there's just so much more capacity to go. There's so much more that needs to be done in this industry. And it's good that governments are starting to pay attention. But there needs to be more. I think we need to see the private sector play a role. We need to see corporates play a role in sort of this whole industry. And I think this is, I don't see any other path for us as a whole region forward other than sort of establishing these new startups, establishing these new technology companies, and building them up to the level where they're substantial and they can hire and they can recruit people and build the next generation of industry for us here in the region. So, yeah, pretty important, I think.
And if you think about it, Bahrain's vision lies a lot on supporting entrepreneurial spirits, and that's what you guys exactly do. You're literally investing on entrepreneurs. Yeah, that's
what it is. I mean, we have to invest in companies that have the ability to scale. So it's not just a normal SME or a small sort of company. We need to be a bit more selective. So we're looking for founders that can scale a business from $0 to $1 million in a year, right? That's really what the objective is. And so, yeah, we're supporting sort of the Bahraini vision, and we hope that continues. And we're doing that all across the region, really. We're investing in startups in every market in the Arab world.
So if someone wants to follow your footsteps, what would be your advice be to them? What's a good starting point?
My footsteps are complicated, I guess. Um, Look, I think the first thing that I did was I started reading a lot. So there's a lot of blog posts. There's a lot of books out there about venture capital as an industry, about from VCs themselves, talking about how they look at deals and all these sort of things. So, like, honestly, I learn a lot by reading, and it's just reading as much as possible to gain as much knowledge as possible. So reading should be part of your day-to-day routine. Is, even if you're stuck for a few minutes doing something, waiting for something, you can read through a blog post in 5 minutes. So it's not really a big thing.
Can you recommend me some of the books?
Yeah, so there's Venture Deals by Brad Feld. That's probably a really good one. It's a very good basis for the understanding of the venture capital industry as a whole from a deal making perspective, which is probably a big part of it. And then there's a couple of other books, not really focused on venture capital, but more on like technology businesses and startups and how they grow and how they manage and things. And so there's Ben Horowitz wrote a great book about the hard thing about hard things, which is his startup journey and all the ups and downs that went through it. Ben Horowitz is now one of the founding partners of Andreessen Horowitz, which is one of the premier VC funds sort of in the region. And then you have sort of the blog post that Paul Graham used to write, which is Paul Graham is the founder of Y Combinator, which is probably one of the biggest, the gold standard for accelerator programs in the world. And he used to write quite great sort of blog posts about the whole startup journey and industry and all that sort of stuff. So that was pretty cool. And just read, like any go and find out who the top VCs are and start reading all of their stuff. And like VCs do write a lot, do lots of videos. Like the new fund that I liked is Initialized. Gary Tan and a few others, they've been doing a lot of video content, which has actually been pretty cool for the newer generation. So it's just like get as much knowledge as you possibly can. I started in asset management. I started in wealth management and asset management, and then did my own startup, and then fell into setting up an angel group, and then after that, setting up a VC fund. So that was my journey. So I don't know how someone would figure that out, because I didn't know what I wanted to do when I was like in my 20s. I thought I knew, but it wasn't what I wanted to do. So I think the idea is that maybe go and work in a startup, maybe go and start your own startup and experience it from the inside out. Maybe go and work for a VC fund. Like there's more VC funds now, and so they're always hiring interns and sort of junior analysts and stuff. So there's not a lot of those roles that are available, but there are, and there's more that are being established every day. More VCs are coming on board, and so that's working pretty well. So yeah, I don't know what my advice would be. I guess there's a lot of different ways into VC. Just figure out something that works.
Right. So looking ahead in 2021, what would be the main themes in venture capital deals?
I don't know. I don't like to sort of look into the future too much, I guess, because I don't really know what's going to happen tomorrow rather than anything else. I'm not like a savant, but generally what we saw in 2020 was a little bit of a slowdown, especially at the seed stage. So there weren't a lot of seed stage funds, startups that were getting funded. And what that will result in the next few years is there might be a reduction in the number of deals that get to Series A and Series B, especially since a lot of the funds that have been established in the last year or two are more focused on Series A stage. So there might be a little bit of a funding gap that takes place there. So that might be something to be concerned about, but I think that was probably a short-term blip, and in 2021 we're going to see a return in terms of funding at the seed stage. We're going to start investing soon as well, so that should help. We're going to do about 30 to 40 deals a year, so there should be some impact there. I think we're going to continue to see adoption of technology. I think what we saw during the COVID crisis is that most people started to shift their habits to online purchases, using apps instead of going offline and doing things. And so what we saw was a wholesale shift from what we thought was going to take over 3 to 5 years so that people started to do things digitally. It happened almost overnight in many markets because there was no other choice. You didn't want to go out. You had to do everything digitally somehow. And so I think that trend woke a lot of people up, especially a lot of corporates, a lot of the more traditional businesses where their business was suffering, but someone that was doing exactly the same thing online was booming because, that's sort of where consumer spending started to shift to. So I think we're going to continue to see that. We're going to see probably more attention from older conglomerates, families, offices, and corporates into the venture capital and technology industry. I'm hoping that they start looking into existing VC funds. They start looking at working with these funds, investing in them, partnering with them, doing something, rather than trying to rebuild the wheel themselves. I think that's not always a good thing. So I think that wholesale shift is going to start to increase over in 2021. I think the other thing that I think will happen is we're going to see more funds that are going to continue to be established, and we've seen a pipeline of those. And we're going to see more deals. I think we're still going to be on a upward trajectory in terms of the number of deals and the amount of funding that's available to these deals. And numbers are just going really, like, the industry is doing well because it's an opportunity. And this is what's happening in terms of the consumer shift is towards doing things online, digitally, apps and websites. And I think that now the whole world, the whole industry, especially in the MENA region, sort of needs to shift to accepting that as a reality and figuring out how to operate in that sort of new world, new universe of digitization. And I think that's gonna do pretty interesting things for VC. I think that's probably the biggest broad thing that's gonna happen, I guess.
I think you already answered my question that I was just about to ask. It's about the fact that there were so many businesses that failed during the pandemic. So what would your tip be for those entrepreneurs to survive?
Look, I think that as soon as we started to see things were uncertain in the pandemic, we told a lot of our companies, look, figure out how to survive. Like, fix your cash flows, reduce your expenses, do whatever it takes for you to be able to survive for the next year. And we told them this sort of in March-ish when things started to get serious. And any of the startups that took that advice have not only survived but thrived after things bounced back, because when things reopened, things bounced back quite quickly. The startups that didn't take that advice are suffering and probably will shut down or have shut down already. The blood in the veins of a startup really is cash flow, and so if you're able to manage that and conserve that, then you're going to be able to survive. If you spend that recklessly, then you're not going to be able to survive. For any startup that's out there, I think, look, it's not an easy time to fundraise. It is difficult. It's taking much longer than you would like. There's less people that are willing to have conversations, even though people are still investing, but it's just slower than it was before. People are doing a lot more due diligence, which is a good thing, I think, in general. But my advice to any startup is, if you really believe in what it is you're working on and what you're building, find a way to build it and find a way for it to scale, find a way to grow it. And I think that if that's the objective of a startup, right? It's not to raise funding. It's not to raise money for venture capitalists. It's not to do any of that. It's to build something substantial. And so if you're able to show that you're building something and there's customers and consumers and people are coming and you understand how to scale that and grow that and do that, then VCs will come, then investors will come. It's not the other way around. It's not, I need an investor so I get started. Like, don't ever do that, because that just doesn't work. You've got to go get started, build something, and then investors will get interested. So it's probably the key advice that I have to a lot of startups, especially in Bahrain. There's a lot of people that have PowerPoint presentations but do nothing with them for like 2 years, and I'm like, well, in that time where you've just been running around trying to get funding, there's been this startup that didn't raise funding but has been scaling and now is raising funding, and they're beating you because you've just been running around with a PowerPoint presentation. But a PowerPoint presentation, an idea, is just worthless. So you really got to build something, and that's what you're going to be able to do. It's hard. It's not easy. But yeah, that's the advice.
I think getting started and just getting to action is more important than perfection in that sense, right?
100%. Like things are never going to be perfect. Things are never going to be ideal. And that's what a startup is. It's always going to be a little bit messy. It's always going to be a little bit difficult. You just have to start. You have to build. You have to grow through that. That really is the idea. One of the things that we look for in our founders is a bias towards execution. They're not just sitting around from one phone call to another with us. In that period, whatever it is, they've built this or done that or launched this or grown this or whatever. So that's what we want to see, that bias towards execution, and that's very important in a startup and founding team.
Thank you so much, Hassan, for joining us today. That was a really nice chat with you.
Great. Thank you so much for having me. I hope this is useful to the listeners out there. Thanks, everyone.
Thank you guys so much for tuning into this episode. If you like this episode, please don't forget to subscribe so that you don't miss out on any episodes.